Gary DeWaal here, and this is Bridging the Week for February 9th to 13th, and today is February 16th, 2015. Good morning. Last week, the week ending with Valentine's Day, Chairman Timothy Massad went hat in hand before committees of the House of Representatives, where he was shown little love while seeking an increased budget for the Commodity Futures Trading Commission. Also last week, the CFTC postponed the rollout of certain new requirements for large reportable traders, while two non-U.S. regulators continue to assess potential new rules related to swaps clearing and execution. We have a lot to cover this week on Bridging the Week, so let's get started. Timothy Massad, chairman of the Commodity Futures Trading Commission, advocated for a 28% increase in funding levels for the agency from fiscal year 2015 to 2016 before members of the House of Representatives last week. Overall, Chairman Massad requested a funding level of $322 million US, up from $250 million US for fiscal year 2015, that would fund, among other things, an increased authorized staffing from 746 persons currently to 895 persons next year. He claimed the increase was necessary in order for the CFTC to fulfill both its traditional responsibilities in connection with the oversight of futures and options trading, but also new responsibilities imposed by the Dodd-Frank Wall Street Reform and Consumer Protection Act. Chairman Massad told the House members that of the requested $72 million US increase, $28 million would be allocated to technology, while the remainder would be spent on personnel in quote-unquote critical areas such as enforcement, surveillance, examinations, registration, and compliance. Chairman Massad requested additional resources before the U.S. House Appropriations Committee, Subcommittee on Agriculture, Rural Development, Food and Drug Administration, and related agencies on February 11th. Public reports reflect that chairman of the committee, Representative Robert Aderholt, Republican of Alabama, was less than enthusiastic in responding to Chairman Massad's request. The following day, February 12th, Chairman Massad was more explicit in telling members of the House Committee on Agriculture what the CFTC would be limited in doing if it did not obtain more resources. Among other matters, he claimed the CFTC would be unable to review and approve in a timely manner new registration applications from new swap dealers and swap execution facilities, in addition to new clearinghouses, domestic exchanges, foreign boards of trade, and other market participants, would be unable thoroughly to examine critical infrastructures such as clearinghouses and exchanges, and be somewhat limited to quote-unquote engage proactively in addressing new risks such as cybersecurity. The Commodity Futures Trading Commission further delayed the rollout of new large trader reporting requirements that initially were adopted during November 2013, the so-called OCR Final Rule. Under the OCR rule, the CFTC expanded upon its prior large trader reporting regime and required the electronic submission of certain large traders and position holder data on updated forms. Original compliance with the OCR rule was required by August 14, 2014, but this date was delayed for all but the record-keeping elements. Because of the slower than anticipated development of necessary technology, the CFTC has further delayed the implementation date for requiring the electronic transmission of certain new forms subject to conditions. Both CME Group and ICE Futures US amended their rules to conform to the OCR rule, revised implementation dates. The Financial Industry Regulatory Authority fined Lightspeed Trading LLC, a registered broker-dealer, $250,000 US for helping three unregistered brokers conduct business from June 1, 2008 through June 30, 2012. FINRA claimed that during this time, the three entities solicited customers to trade through accounts at Lightspeed, and Lightspeed paid these brokers transaction compensation while they were unregistered. In addition, one of the unregistered entities, alleged FINRA, engaged in trading activity that appeared to be spoofing or layering. However, Lightspeed never investigated the trading, claimed FINRA. Accordingly, FINRA also charged Lightspeed with failure to maintain and follow adequate anti-money laundering procedures and failed to follow its own procedures related to the investigation of potentially suspicious activity and the filing of suspicious activity reports. Craig Lax, the former chief executive officer of G-Trade Services, LLC, a U.S. registered broker-dealer, agreed to pay disgorgement of $783,000 US for his role in the firm's overcharging of customers in connection with certain of their security transactions. According to a complaint filed by the SEC against Lax in a federal court in New Jersey, from at least January 2008 to August 2011, G-Trade engaged in a fraudulent scheme, quote, to conceal from customers a practice of charging hidden markup and markdowns on security trades, end quote. This was arranged, claimed the SEC, by G-Trade routing customer security trades for execution through a subsidiary, Convergex Global Markets Limited, a Bermuda broker-dealer. On occasion, customers of G-Trade ultimately paid both an agreed commission and a hidden markup or markdown assessed by Convergex if the traders at Convergex, quote, believed they could add a trading profit without detection by the customer, end quote. In addition to paying disgorgement, Mr. Lax agreed to be suspended from the securities industry for at least 5 years and to cooperate with the SEC going forward. He may be subject to payment of a fine too. Both G-Trade and Convergex are wholly owned subsidiaries of Convergex Group, a New York-based firm. And finally, the Canadian Securities Administrators is seeking comment on a proposed rule and policy related to the mandatory clearing of derivatives. In general, CSA proposes that in connection with an OTC derivative subject to mandatory clearing, a local Canadian counterparty must submit the transaction to a regulated clearing agency. However, substituted compliance may apply to transactions involving a local counterparty, where transactions are submitted to clearing subject to the laws of a Canadian jurisdiction other than the jurisdiction of the local counterparty or certain foreign jurisdictions. Exemptions from mandatory clearing requirements are contemplated where one of the counterparties is not a financial institution and engages in hedging or risk mitigation and for intragroup transactions. Comments on CSE proposals are due by May 13th. Separately, the Monetary Authority of Singapore determined not to impose a mandatory trading regime for OTC derivatives at the present time. Well, that's it for this week's Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. For those celebrating Chinese New Year, Happy New Year. Have a happy week for everybody, and ciao.